Good afternoon, everybody, and welcome to this week's weekly macroeconomics session for Friday, the 3rd of July 2015. David McCulloch here with you this afternoon. Jeff's taking a small break, so he'll be back next week. All right, let's get underway. Let's get into things and see what's happened on the markets this week. But first, as always, our disclaimer. And it states that the content of this presentation or any other Elite Traders Club material does not constitute a recommendation, nor does it take into account your investment objectives, financial situation, nor particular needs. So before making an investing decision based on the general advice presented in any of our presentations, please consider whether it's appropriate in light of your financial circumstances. Quick reminder, the Elite Wealth Academy this year up on the Gold Coast at Century Cove on the 28th of August through to the 2nd of September. We've got a great lineup this year, totally flexible in terms of sessions that you can go to, great topics that we've never taught before. So certainly if you've got some free time in your diary, see if you can come along to that. We'd love to see you there. And some nice images of the resort in itself. And if you like, you can have a game of golf, a massage, a spa, etc. All right, let's get underway. The week in review in Australia this week. The year has gone past quickly, so has the week. We had private sector credit there coming in at 0.5% versus 0.5%. So no upsets there in terms of sector credit in the private area. The RBA governor spoke on Tuesday, and basically all Glenn Stevens really said then was, in his summary, gave a bit of an overview of monetary policy and the role that the RBA has in trying to keep the economy moving in the right direction through interest rates, either moving interest rates up or down, and the impact and I guess his job in terms of trying to maintain a balance between inflation and growth in the economy, so jobs, employment, confidence, those sorts of things. And he took a look at how other countries' central banks were trying to do similar sorts of things and how their focus on monetary policy had changed over the years and where that had currently led some of the major economies in the world. So that was pretty much the context of what he was talking about on Tuesday. Our trade balance came in at minus 2.75 versus 2.25. So a little bit of a discrepancy there. Certainly the deficit was greater than expected, but it was an improvement on April figures. So we'll just have to wait and see what pans out over the course of the next month or so. Retail sales came out today, and there was certainly a bit of a drop in retail sales, which is a little bit unusual given that we've had the interest rate cuts in previous months. Certainly some of the areas that had picked up in retail sales was the area of personal accessory retailing. That was up 0.8%. Household goods retailing was only up 0.3%. Things such as takeaway foods, department stores, etc. were pretty much unchanged. So certainly just the smaller items was where there was some growth, but overall a net decrease on the previous month. So as yet, certainly not a lot of consumer demand following through, which is something that I think Glenn Stevens would certainly like to see, that those interest rate cuts are having an impact. A lot of people at this point in time conserving a lot of their money, taking advantage of those interest rate cuts and just increasing their amount of personal savings, really paying down mortgages, debt and those sorts of things alike. And as a result, those figures, those retail sales being a little bit disappointing, and the market today moving to the downside after that particular announcement. I think at the same time, given the fact that we've got the long weekend in the US this weekend, the 4th of July, markets closing over there. All the distractions, the Eurozone with Greece as well. It's probably a time for the market to just take some shelter and see what happens into next week. Obviously, over the course of the weekend, we've got the Greek referendum as well. In the US, we had non-farm employment change at 237 versus 219. Consumer confidence over there 101.4 versus 97.1, which is a good thing. So obviously the consumers in the US drive a lot of the economy over there, and the fact that consumer confidence is improving, consumer confidence being a forward-looking indicator, is one good side for the Fed, looking for their at some stage to be changing their interest rates towards the upside. So consumer confidence is one thing that they would certainly be looking at. In terms of employment, private employers hired the most number of workers in 6 months in June, and factory activity accelerated during that time frame as well. So again, a little bit of evidence there that the economy is slowly gathering momentum since contracting at the beginning of the year. Auto sales in the US remain strong in June, and construction spending rose throughout May as well to its highest level in about 6.5 years. So again, it's the sort of data that the Fed's looking for at this particular point in time. However, on the flip side of that, the underemployment rates fell in the US, and at the same time, hourly earnings, the rate of hourly earnings, has really remained stagnant for quite a period of time. So, in fact, over about the last year, there hasn't been significant change in the hourly earnings at all. And the poor old Yanks are earning on average around about $25 an hour, which is about the same as it was the previous year. So, again, something for the Fed to be thinking about. Obviously, Janet Yellen, from her point of view, has mentioned that wage growth isn't necessarily a prerequisite to short-term interest rate increases. It is possible that inflation could start rising even without much wage growth. But in the absence of evidence of a pickup in either inflation or wages, then the Fed officials are really going to, I think, have to proceed with a fair amount of care and a fair amount of caution as well. At this stage, we're looking at somewhere between September and December for rate hikes. They're sort of penciled in around about that time. Again, some of the other concerns that they're going to have is what's happening in the Eurozone at the moment, and whether or not any of those concerns spread to the US. And if that happens, then I dare say those rate increases, they're probably going to be a little bit more cautious, and they might be delayed a little bit further. In the Eurozone, obviously we had the Greek debt repayment due, and they've obviously defaulted on that. At the moment, they're having a referendum this weekend to see whether or not they're going to choose to abide by the Eurozone's suggestions, or whether they're going to try and go their own way. There's certainly been some discussions between the Greek Prime Minister and his Finance Minister. I think the Finance Minister really wanting to be supportive of the Eurozone's requirements, but I don't think the Greek PM's having anything to do with that. So again, it's going to be certainly a volatile time on the European markets, which may well spread further abroad. So let's go through and have a little bit of a look at some of the impact of what's gone on in the Eurozone this last week on our particular market. So let's go through and have a look at Beyond Charts. So this is our market, and last week you can see that I drew in this channel, which was basically just framing, if you like, a major sort of peaks and troughs in what is now certainly a very much a downward trending market. This time last week, we had just moved up to the upper reaches of this downward trend line, and we were just seeing the classic 3-bar reversal, and mentioning at the time that wouldn't be surprised for the market, given what was going to happen in Greece last week with their decision whether or not they were going to accept the Eurozone's requirements, that this market may well move down. And it pretty much did. It moved very quickly down towards the bottom area of this particular channel. We had the end of the financial year coincide with this move down. And at the same time, that represented an opportunity for a lot of fund managers who were getting out of particular stocks, looking to close positions, but also open up new positions as well. So obviously with those closed positions, they can close off the books and lock in profits, gains and things throughout the year and make their portfolios look really good. So what we might refer to as window dressing. And then at the same time, take the opportunity to therefore acquire new stocks. And at the same time, on this particular, the third last day, the market opened up and started to move down, only to rebound in the latter half of the afternoon, and we've had a few days of follow through since then. So again, we're starting to get back up towards the top part of this the channel again. We really do need to break our way out of this particular channel to see any immediate move to the upside. As you'll see at the same time, on our stochastics down below, we are just about to move into very high risk territory today on the market. Obviously, Beyond Charts doesn't pick up data until after 4:30 today. Our market being down a fair bit at what is around about 1 o'clock this afternoon. So wouldn't be surprised to see us down into extreme territory by the end of close today. So again, we're going to need to make some adjustments on the portfolio if you are still holding stocks at this particular point in time. If you haven't been stopped out on any of your open trades, it just means that those stocks that you've got are exhibiting good relative strength, and that's the sort of thing that we want in our portfolio, because if this market does rebound, then those stocks are likely to move up quite quickly. So that's what's happened on the Australian market this particular week. Going over into the US with the S&P 1500, our benchmark there, you'll see that we have just gone into moderate risk. So our stochastic is now down below 80. We're now between 60 and 80. So again, that's going to have an impact on our portfolio value at risk and the market risk multiplier that we use. So certainly this market has really struggled to get above the sort of 490, 495 area. Fairly low volatility through here, and quite often what happens in the market is low volatility begets high volatility, and then at the end of your volatile explosions, etc., the markets tend to settle down again, and we get low volatility, and the cycle goes again over and over. So certainly a fairly big down day after the weekend. Stocks have moved up a little bit. No great sign of conviction. Fairly small bodies on these particular candles, which has pretty much been the theme right throughout this year. Prices moving back up. Obviously, the market being closed over the 4th of July weekend means that we're not going to get a lot of direction from the US over the course of the next 4 or 5 days into the middle of next week. So our market certainly isn't going to get much in the way of clues from the US. One thing that has come off a fair bit is the Aussie dollar. The American dollar being fairly strong of late, and I think the fact that there's a little bit of worry in the world at this point in time has resulted in the Aussie dollar coming down below 77, down to 76 level as we speak. On the markets next week, let's see what data we've got coming up. We've had a look at the markets. Next week on Monday, we've got the ANZ job ads month on month, which will be important given that we've had some interest rate cuts. Looking to see some growth in the number of job ads posted. So certainly that's something that the market will be taking good notice of. The cash rate on Tuesday, I'm not expecting the RBA to do anything with its cash rate at this point in time. You might remember in previous occasions, when in doubt, it tends to sit on its hands. I think at this point in time, we just need to see a little bit of evidence of growth in the economy. Employment change, the employment rate on Thursday, so it'll be interesting to see whether that what direction that takes, and if there's been any increase in any particular sector. Evidence recently is suggesting that it's more the finance and services area that is making some gains, albeit small at this point. Home loans month on month on Friday. That figure can be quite volatile, moving up and down from month to month. Interesting to see whereabouts those home loans are occurring and the growth in which particular sectors or states of the country the home loan growth is occurring in. In the US market, we've got labour market conditions index on Tuesday, the trade balance on Wednesday. So it'll be interesting again to see what happens there with the recent rebound in the US dollar. We've got the FOMC meeting minutes on Thursday. So again, just reading between the lines with Margaret Yellen's going to have to say there and what their timeline is for their proposed increase in interest rates, whether or not that is going to suffer any changes as a result of what's happening in the Eurozone, or whether the talk's fairly much on target for that September through to December sort of time frame. Who knows at this stage if we do get a bit more impact, a bit more volatility in the markets, it may well push those interest rate decisions back into 2016. We'll have to wait and see. And China, PPI on Thursday, so producer price index. So just seeing whether or not there's any inflationary suggestions at the producer level. Again, obviously, if that's something that does come through at that particular level, then those costs generally get passed on to the end consumer. Certainly a lot of things happening in China at the moment. Their market particularly volatile. Big swings this week of down 6 or 7%, up 4 or 5. And again, a very difficult market to be in, and certainly something that if you were invested in, you'd want fairly wide stops. Or some key parameters to make sure that you're not unduly exposed to those big market swings with a lot of things happening in terms of their monetary policy and amount of credit that's available in that market. Well, that's about it this week on the markets. Don't forget Monday morning 9 a.m. for our weekly analysis session. There'll certainly be a number of trades in the pending list that will be cancelled this week due to very weak price action, as you would expect over the course of this last week with everything that's happening in Greece and the Eurozone. There's still certainly a number that are holding up reasonably well that haven't yet triggered but haven't yet formed that inferior price action that we look for before we cancel a trade. So keep an eye out for your invitation, which will arrive in your inbox sometime this afternoon for that webinar on Monday morning. Until then, have a good weekend, and we'll catch up with you 9 a.m. on Monday. Thanks for listening.